All right, children, welcome back. Today, we're going to be talking about the money market. All right, children, so the money market. This is the market where the suppliers of money and the users of money interact to set the nominal interest rate. Your nominal interest rate will go right here. This is our equilibrium nominal interest rate. First and foremost, your nominal interest rate is going to be labeled a lowercase I. We've already used capital I for the real interest rate, so we're using I, lowercase I, for the nominal interest rate. Remember, the nominal interest rate means the interest rate in this year's dollar value. So this is essentially just the price of borrowing money based on how much a dollar is worth right now. Down here in quantity, it's going to be the quantity of money supplied. So remember, this is literally just price and quantity. It's just now, instead of the price and quantity of hamburgers or cookies, it's the price and quantity of money. So the money supply curve is going to be straight up and down, and the whole reason that that curve is vertical is because it is controlled or set by the Federal Reserve. Only the Fed can affect the money supply curve, and so because of that, it's straight up and down. If the Fed isn't using one of the three tools to affect money supply, this curve is not going to change. Remember, those three tools are the discount rate, reserve requirement ratio, and open market purchases or open market operations. Okay, money demand is affected by the users of money. So money demand is affected by the users of money. The users of money are the ones that affect the money demand curve. If we need to spend more money because prices are going up, well, the money demand curve increases. If we need to spend less money because prices are going down, money demand curve could decrease. Okay, so this is our nominal interest rate, and we're just graphing the change to the nominal interest rate. Way up here at the top, this is what we call our transaction demand of money. Transaction demand. And what that means, this is the money that we demand in order to make our everyday transactions, our purchases of goods and services. It's not affected by the interest rate, and so because of that, it's all the way at the tip top. You don't check the interest rate before you go to the grocery store or before you go buy a latte at Starbucks. And so because of that, transaction demand of money is not affected by the nominal interest rate. However, the rest of that curve is, and the rest of that curve is our asset demand for money. This is the demand for money to use it as an asset or a way to earn more money. So think about it like this. As the nominal interest rate decreases, our asset demand for money decreases. And what I mean by that is, as the nominal interest rate goes down, your opportunity cost for holding money in your pocket or spending it is decreasing. Your opportunity cost of spending money is the interest that you could have been earning if you left that money in a savings account or maybe in a time deposit like a CD, a certificate of deposit, something like that. So as the nominal interest rate decreases, so does the opportunity cost for holding money in your pocket or spending it, so that's going to cause us to spend more. As the nominal interest rate increases, the opportunity cost for spending money is getting higher, and so you're missing out on more interest when you're spending your cash or not leaving it in the bank or putting it in a time deposit or some other interest-bearing asset like a bond, something like that. So as the nominal interest rate goes up, the opportunity cost for spending money is also going up, so we're more likely to spend less. All right, let's talk about what shifts these curves. All right, so the things that shift this money supply curve, there's three of them. Again, three tools of monetary policy. The first is the discount rate. If the Fed wants to increase the money supply, then what they need to do is lower the discount rate. That means that they're going to charge commercial banks less to borrow from the Fed. If commercial banks get charged less, they'll charge us less when they give out loans. They'll give out more loans. Money supply curve will increase and shift to the right, lead to a lower nominal interest rate. If they want to decrease the money supply, they can just do the opposite. They can increase the discount rate, which makes it more expensive for commercial banks to borrow from the Fed, which will lead to less borrowing. They'll pass that increased price on to us. It'll cost us more to borrow money from the commercial banks. Money supply will decrease and shift to the left, and we'll have a higher nominal interest rate. The second tool of monetary policy that affects the money supply curve is going to be the reserve requirement ratio. If the Fed wants money supply to decrease, they can increase the reserve requirement ratio. That'll make it where commercial banks have to hold on to a greater percentage of demand deposits, so they can't give out loans. It also makes the money multiplier smaller. And so the money supply curve will shift to the left, and the nominal interest rate will go up, which increases the opportunity cost of spending cash, which will lead to money being spent less often, aggregate demand will decrease. Opposite is true as well. If you decrease the reserve requirement ratio, money supply curve will shift to the right, because now banks don't have to hold on to as great of a percentage of demand deposits. They can give out more loans, and the money multiplier increases. So the money supply curve shifts to the right. We end up with a lower nominal interest rate, a lower opportunity cost of spending your cash. People will spend more, aggregate demand can increase. The last thing that's going to affect the money supply curve is going to be open market operations, when the Fed either buys or sells government bonds. Remember, these government bonds get created when the government is doing deficit spending, and they have to borrow money by creating these government bonds in order to pay for their deficit spending. The Fed can buy and sell these government bonds with banks. So if they want the money supply curve to increase, buy bonds, big money. The Fed will buy bonds from these commercial banks. They'll go up to them, say, hey, we'll take that IOU that says that the government owes you money. We'll take that from you and give you cash. That increases the money supply, but there's also a multiplier to effect to that as well, because once these commercial banks get that money, they are going to be able to loan it out. And if they loan it out, then it's going to have a multiplier effect as well. That increases the money supply, lowers the nominal interest rate, which will drive down the opportunity cost of spending cash, and now people will spend more. If they want to decrease the money supply, then they'll sell bonds small money. When they sell bonds, what they're doing is they're going to these banks and they're saying, hey, I'll give you this piece of paper. I'll give you this piece of paper that says the government owes you money. You give me all your cash. And so now they're taking cash out of these banks. Those banks can't loan that cash out anymore. That's going to decrease the money supply, leading to a higher nominal interest rate. That's going to increase the opportunity cost of spending cash. People won't want to spend as much. People won't be taking out loans. Aggregate demand will decrease. All right, the money demand curve can also be shifted. Anything that causes people or the users of money to change habits for the use of money is going to shift the money demand curve. First one is inflation. If inflation increases, users of money will need more money to keep buying goods and services. That will cause the money demand curve to increase. If the money demand curve increases, we end up with a higher nominal interest rate. If the money demand curve decreases, we end up with a lower nominal interest rate. Another thing that's going to affect that is growth. If the GDP is increasing, more people are having jobs, more people are spending money, the money demand curve is going to increase and shift to the right. If GDP decreases and we go into a recession, we'd expect the money demand curve to decrease and shift to the left. And then finally, credit card use. Credit card use will also affect the demand for money. A credit card is not money. You're essentially taking out a loan from a corporation. And so if you are using a credit card instead of cash, well then the money demand curve is going to decrease and shift to the left. If we stop using credit cards because we're worried about debt, then the money demand curve would be expected to shift to the right and lead to an increase in the nominal interest rate. Now let's do practice.
We're in here talking about practice.
All right, for this first problem, I'm going to pretend like we're in the midst of a recession. So we're over here. Remember, in a recession, the biggest problem is high unemployment. So in order to fix this, we need to focus on making it easier for people to spend money. We need aggregate demand to increase and shift to the right. So what we need to do is increase the money supply. The Fed is going to be in charge of controlling the money supply. When you're doing one of these problems, you need to think to yourself, if it asks a scenario, you say, well, is this something that affected the users of money that would make people want to spend more or spend less? Or is this something that affects, that the Fed did? Did the Fed do something? The money supply curve is only going to move if the Fed did something. It is not affected by us. Okay, so we're in a recession. The Fed decides we're going to buy bonds in order to get people to spend more money. If the Fed buys bonds, that means the money supply is going to increase. Remember, buy bonds, big money. So the money supply curve will increase and shift to the right. Now we have an increase in the money supply. I can show that it shifted to the right. There's more money available. Oops, I forgot to label this. This is a lowercase I because this is the nominal interest rate. Lowercase I for nominal interest rate. We already used capital I for the real interest rate. Next, we have a new lowercase I for the nominal interest rate. Our nominal interest rate is decreased. And so because of that, the opportunity cost of spending money has decreased. So people are more likely to use their cash or walk around with cash in their pocket. They're less likely to save it in the bank because they're not missing out on as much interest that they could have earned by leaving their money in the bank. Also, there's more money available. Banks now have it. They're flush with cash and they can make bigger loans or make more loans to people. This increases the money supply, lowers the nominal interest rate, which will cause aggregate demand to increase and shift to the right. Obviously, what happens here is that the price level increases. Inflation is rising. If you increase the money supply, you're going to have inflation. If there's more dollars, then each dollar is going to be worth less. All right, let's move on to a second one. All right, for this next one, this next example, what happens if we're in an inflationary gap? Prices are getting too high. The Fed decides that they want to control the high inflation. They want to bring these prices back down. So what they need to do, or their goal, is to decrease aggregate demand. In order to decrease aggregate demand, they're going to have to do something that causes the money supply curve to decrease and shift to the left. There's three things they could do to do this. They could either increase the reserve requirement ratio, which would make banks hold on to a greater percentage of demand deposits, or they could increase the discount rate, charge commercial banks a higher interest rate when they borrow from the Fed, which will cause those banks to turn around and charge people a higher interest rate when they borrow from the bank, leading to less loans, less money being spent. Or what they're most likely to do, because it's their main tool, they could do an open market operation. They need to either buy or sell bonds. To decrease the money supply, they're going to have to sell bonds, small money. So if they sell bonds, the money supply curve shifts to the left. There's now less money available. Q1. Our nominal interest rate, which again is a lowercase I, because real interest is an uppercase I, remember we've already used that one. Our nominal interest rate increases. It is now more expensive to borrow money. So the price of borrowing money in this year's dollar value has gone up. So, money supply curve decreased, nominal interest rate went up. The opportunity cost of spending cash or walking around with it in your pocket is now higher. It would be better to put your money in a savings account or maybe in a time deposit, like a CD, a certificate of deposit. That'd be a great time to do that now because the nominal interest rate is higher. So, that's going to lead to people spending less money. Plus, money supply decrease is going to lead to people being able to get fewer loans. They won't be able to get as many loans as they used to be able to. So what happens here? People spend less money, aggregate demand will decrease and shift to the left. We end up with a lower price level. Inflation is going to decrease. If there's less money, that means that each dollar is worth more and you won't have to spend as many of them to get things. So that'll bring your inflation down.